bullish uranium. I still think that tight, I call it a 80. I still think it's a market that you have to be in. I think that Chris Wright, Trump's secretary, is going to make that a more visible portion of the U.S. energy portfolio. And I think that at some point he just might announce that we're going to start opening up nuclear reactors here and there to start creating baseload power for whatever reason, for whether it's for computer generation, AI generation, or something or other. But I think that once that mechanism gets in place, that the price of uranium can go up. So
welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a fantastic discussion lined up. We're fortunate to have with us Tony Greer, founder of the Morning Navigator and Macro Dirt podcast. Tony, welcome back to Metals and Miners. Thank you so much for joining us today.
Gary, anytime. Thank you for having me, man. I appreciate it. How you doing?
I'm wonderful, and I really enjoy talking with you. All right, let's jump in. Tony, you've been a strong bull the last few years, while many have been bearish and expecting a recession, and that recession never came. You've made a lot of great calls over that time. I want to give you kudos. All right.
Thank you.
So there's so much drama unfolding in Washington, D.C. right now. President Trump's crackdown on corruption, Elon Musk's fiscal transparency revolution through Doge, Scott Bessent, the new Treasury Secretary. There's a lot of things that are happening that are shifting the landscape very quickly. Would you speak into how you see Trump's focus impacting markets and specific segments, and if you see Trump 2.0 as being bullish for the natural resource sector?
Oh, man, there's a lot to unpack there, Gary, but I'll do it a little bit at a time. It's a great question, and it's one that all my clients are asking me, and I'm trying to be accountable for with my views. So the way that I'm looking at it is, I guess what I like, I definitely dial into listening to Scott Bessent yesterday, like when he was on Bloomberg TV. I think it's important to hear what these guys are saying and how it applies to the markets. So I think it's pretty cool. First, that kind of to work backwards is that, he set himself up yesterday with a really good story as a U.S. Treasury salesman. He said with what Elon Musk is doing with Doge, we're going to be cutting costs. We're going to lower interest rates. We're going to lower the cost of energy. The things that President Trump is doing, Scott Bessent is saying, not me, the things that President Trump is doing are going to be disinflationary, right? So that gives me credit, and it actually kind of turns my view on its head a little bit, and I have to respect that, so I kind of go with that more. I'd originally thought that Trump was going to be dealing with a lot of leftover inflation from the Biden administration, potentially from Powell, with a little bit of a policy error, maybe keeping rates too low for too long. So it seemed like we have a little risk of inflation, and we saw a little bit come back in the headline numbers, right? Just a little bit hotter than expected CPI, PPI last week. Worth noting, but I think that the things that Trump is doing are actually going to override that. And I think that they're going to be much bigger than the people or the market, just not forget people, that the market has adjusted for yet. I really don't think that the market comprehends the amount, and I'm not as concerned as a citizen with the amount of corruption, fraud, and everything that they're uncovering. But as a market player, you got to be concerned with the sort of volume and the amount of money that they're going to save that is not going to go out overseas to completely ridiculous causes that have no benefit to the U.S. Rather, they're going to figure out how to not let those funds go overseas. And it seems like we're going to be just America first with all that money. And if we're going to also start collecting money from tariffs, and I have to listen to the fact that they're talking about canceling the IRS, and there are things out there like canceling federal income tax. Now, I don't know if that's going to happen, but all of this stuff sounds like it is going to benefit the American consumer, for starters, and definitely, benefit the U.S. bond market. Because I feel like if, with our deficit at 37 trillion or whatever it is, like all this administration has to do is optically stop the bleeding. And I think the bond market is going to celebrate that. You know what I mean, Gary? Like, I
Yeah.
don't know if they're going to actually come in and stop the deficit from growing. Like, it may continue to grow, but if they slow it in its tracks, if they figure out how to make some concessions and keep money onshore, like we're going to start collecting tariff money, and that's going to go into a sovereign wealth fund. So I just see a lot of strength coming back into the U.S. I see it all being good for the consumer. I got a feeling that it's going to be a little bit like Trump too. And then I've got the market speaking to me. So who cares what I think? Like, quite honestly, like, no offense about what I just said about the markets, but it's not as important as what I see going on. So what I see going on in the equity market I'm still really keyed in on the breakouts that took place while Trump broke away from Kamala in the polls last, call it October, right? Heading into November election, and then things continued from there. But when Trump broke away in the polls, the first thing that happened was Bitcoin went from 70K to 100K, right? He's the friendliest crypto president we've ever had. Now, that's one trade that's still in motion. Financials and broker dealers broke out like a house on fire. They're still going, right? Internet stocks, software, cloud storage, cybersecurity, they all broke out like a house on fire, while in the background, NVIDIA is having a sort of consolidation moment, and semis are kind of a consolidation phase right now. And I think that they could be a source of funds for some of these other Trump trades, as you say, that are manifesting right before our eyes. So financials and broker dealers are still performing. If you look at the performance so far year to date, you've got gold miners and social media on top, up like 20% and 17% respectively. But then behind that, you've got those, energy has just creeped into the picture. So that's going to get to the second part of your question. Broker dealers are still in the lead. They're up 6% on the year. Financials are up 5%. This trade is in motion. So I guess to get back to the natural resources part of that question, and please interrupt me if I'm going too long without letting you ask another question. But now the dollar weakness is starting to spur the Bloomberg Commodities Index a little bit. So since the dollar finally pulled back from its highs, you've seen the Bloomberg Commodities Index trade from 100 to 108, right? And it looks like through 110, there's a clear range break there. Now, what's all that commodity strength coming from? Obviously, it's coming from gold, 2940 or so. What was it? 2940 last, a bid offer from the highs, essentially. The bull trend is still intact. Central banks are still buying. Elon Musk is talking about walking through Fort Knox. Scott Bessent just said the gold's there, which is news to me. You know what I mean?
News to everybody.
Yeah, exactly. Like, I don't know that that's ever been, confirmed or anything like that. So I think that's interesting. So I want to let you regroup us.
Yeah. No, there's a lot there. That's a great tee up for the entire conversation. So let's go in this direction first, Tony. Since Trump's inauguration, European and Chinese equity markets have actually outperformed the U.S. stock market. For instance, the S&P 500 has gained about 1% since January 20th, while the MSCI China ETF has surged approximately 17%. The iShares Eurozone ETF has risen about 6%. So the iShares China Large Cap ETF is up about 16%, while the Dow has barely maintained a positive since January 20th. Tech leaders, we're talking the Qs, they're up about 2.5%. And the Crane Shares CSI China Internet ETF is up roughly 20%. This is all since January 20th. What are your thoughts on this divergence in performance? What factors do you think are causing it? And how do you see that trend moving forward?
Put it this way, Gary. I want to level this question up the right way so that I can give the most valuable answer. I am a U.S.-based equity trader. That's my bread and butter. That's my wheelhouse. That's how I've always made money. And that's how I've actually, since I've started my business, gotten better at making money, right? So that this is my wheelhouse, living in the United States stock market. Looking outward, though, I see that that's going on, right? I am not going to go chase. I understand that it may work. So, we've been in this massively long period of US outperformance over Europe and over China, right? I understand that with Trump coming into office, now the markets have been sideways observationally, right? No, kind of can't argue with that. But I don't know that the reaction to the reaction out of Europe and China is sustainable. Like maybe that's a great knee-jerk reaction where people are saying, okay, now that Trump's in office, no more US outperformance because that's a Costanza trade, right? The US is really set up to really outperform now, but this is a market, so the opposite is going to happen. That's where I kind of step in and say, I'll call bullshit on that. I'm going to say that the US is going to outperform because the mechanics that we're going to go through here are going to improve, earnings potential for the S&P 500. And that data is going to be undeniable, when those companies start beating earnings and that all gets priced in. So maybe it's kind of one of those things where everybody's saying that this is the trade that's going to happen now, and that China with DeepSeek is going to become a threat, and maybe that's why China's kind of bounced back from underperforming. And I may be wrong on this. I could be wrong. But at the same time, I don't have a skin in this game. You know what I mean? Like I just kind of tend to think that give it some time. And once the U.S., like we're in this consolidation period right now because there's Trump trades breaking out and there's other trades breaking. Healthcare sector's breaking down. The home builders are breaking down. Like there are sectors that are breaking down into this new administration regime, right? So I'm going to stick with my idea that the U.S. is going to continue to outperform and that the gap is going to get even wider over the next 4 years. And if I miss the China trade, if I miss the Europe trade, that's something that I can live with because I've been in the market that's outperforming for the last several years. So I'm going to look for some sectoral trades that I think are going to keep up with China or European indices. And I think that's how I'm going to try to play ball here.
Outstanding. Today's video is sponsored by Monetary Metals. What if your gold could grow over time so that you're not just preserving, but growing your wealth in an asset that can't get inflated away by more money printing? Monetary Metals lets you do just that. You could earn 3% on gold, paid in gold, in their secure gold leasing program. And if you're an accredited investor, you can earn even higher yields in their bond offerings. Previous bond offerings have paid 6%, 12%, and even high as 19%, all in ounces of physical gold and silver. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. The question is this: why earn in dollars when you could earn in gold? Join thousands of investors earning interest in physical gold and silver every single month with Monetary Metals. So visit monetary-metals.com/BOOM to learn more. All right, so you brought up DeepSeek. I do have an AI question here for you, but it's not so much about DeepSeek. But Meta, they approved a plan for bigger executive bonuses following their 5% layoffs in the workforce. I don't know if you saw that.
No, I didn't.
Okay, so yeah, just that news just broke in the last, 24 hours. So they approved this plan where the executives are going to get bigger bonuses, but they just laid off 5% of their workforce. All right, so AI seems to now be replacing workers, especially in tech, right? Where they can use the AI to do more with less people. So this seems to be a situation that's going to exacerbate the divide between the haves and the have-nots. The key employees versus the not so key employees. Well, they're going to maybe be let go because AI could replace those folks. Well, so here's my question. Are we seeing the early stages of AI's impact on the workforce and the divide that some are worried about? And if so, do you expect that those kinds of issues are only going to get worse the better AI gets and the greater the adoption that takes hold?
So I'm not smart enough to know the answer to that question, but I have an opinion and I can offer that. This could be a direct sign of AI replacing physical employees at some level. Could be, right? It's hard to argue, very, very hard to argue with that logic path that's not what just happened. You know what I mean? So I'm not going to argue against you there. What I will say is that I think that some of the other things that Trump is doing are being overlooked in terms of their ability to create jobs. I think that that's getting totally discounted, whereas more of the market seems to be focused and worried on like, oh my God, I mean, is the natural human condition like, oh my God, is the computer going to steal my fucking job? And that's that's my fear as a newsletter author, for God's sakes, so.
I think you're making a good point, because I think you saw the Hyundai news. They're bringing some, because of the tariff threat, they're going to be bringing some plants here to the United States. So, I mean, you're talking about job growth.
Onshoring of U.S.
Yeah. So I think you're making a great point there. All right. So do you have anything else you want to mention on that one?
Just that I think that can be a little bit of the counterbalance. And I don't know if it's going to work out one for one worker kind of thing, but there's clearly going to be, like Isuzu, a couple of other companies said they're going to build their cars in U.S. soil now. I mean, that's going to be the trend.
Yeah.
Right. And so once we get a couple of big companies that say, yeah, you know what, we're closing up shop in China, we're coming home. Right. And that's
or Mexico.
Or Mexico. Exactly. We're coming home, and they're going to try to get all of this credit for saying, hey, we're reshoring. And it's like, how about saying F you for going over there in the first place?
Right. Well,
like there should be a little bit of that too.
That might have been because of the higher level policies, though, that were in place, right?
Yeah, exactly. Well, I mean, they're going where their capital is being treated best. And if labor capital is cheaper across the border, they're going to go pay that price.
That's what I'm saying. Yeah.
Totally
okay.
Fair.
All right. So
they were incentivized to do that. So I don't blame them.
Right. Yeah. All right. So, Tony, Walmart, they're a bellwether for the consumer, the economy. They got pummeled the other day when they issued cautious guidance for the rest of 2025. Today, the Dow is down, I don't know, 600-700, whatever. You're looking at the screen right now. The NASDAQ is down about 350 or something like that on what they're calling weaker than expected consumer sentiment. This is the going rumor here. So is the underlying economic momentum that we've seen over the last couple of years, is it remaining strong? Is it stalling out, or is it weakening in your view?
I'm not an economist or a biologist, but I tend to have a fairly bullish opinion on the economy. Like there's like 10 revolutions going on at once right now, Gary, and I can't even keep my head around them.
It's true.
You know what I mean? Like there's the AI revolution, there's the liquid natural gas trade. We're going to change our entire energy portfolio, I think, here as it contributes to baseload power. We've got the data center computing energy trade, right? Like that's kind of morphing out of this. We've got a big change in airlines, right? Like there's kind of crazy stuff going on. So, and gold miners are the leading sector performing on the year, right? So there's really different shit going on in the markets right now. And the only thing I can do is let the rotation tell me what's going to happen.
Yeah.
And so if retail stocks are going to get crushed or something like that due to a weak consumer, like I can get out of the way of that. Is it going to be something where the entire economy comes tumbling down? Like as Trump's lowering energy costs, lowering regulation, cutting out, no, I don't think that's going to
maybe
happen.
Even giving a Doge stimmy to everybody.
Yeah, exactly. And that's insane to me too. Like I hate that idea. Like I'm not a stimmy guy. I'm not in support. Like Rudy Havenstein says, like I love free money as much as the next guy, but that's the route to $50, acai bowls. You know what I mean? And
so it's inflationary in your view.
Well, giving the checks back, that's inflationary. But there's something here, Gary, where I consistently believe, and they consistently prove, that Trump and Musk know a lot more than they're leading us onto.
No doubt.
That continues to be proven.
No doubt.
In my opinion, right? Where the whole world, they come out and say something and the whole world throws eggs at them. And then it comes out later like, oh, look, see, we were right. Like, how about that? So there's something to me with this Fort Knox search and all the gold that's coming out of London over here. Like
but kind of strange that a team member in Besant would just poo-poo that and be like, oh, no, we just did an audit in September. It's all there.
Exactly. And my friend JJ just wrote out the time that it would take to actually audit.
Yes, I've read that.
Did you?
Yeah.
You know what I mean? And we're talking about if they had 1,000 workers doing it, it's going to take them 4 years to do that. 1,000 workers.
But they just did it in September of 24.
Right, exactly. But it's like, okay, what was that, a real audit? Was that, who knows? Who knows? Was that just for headlines? I mean, I don't know. But it feels like in the gold market, there's some kind of there's a trade going on that nobody can explain, right? With all the physical coming over here from London, it's getting drained out. The EFP blew out. Nobody can really explain that eloquently to some level that I can understand yet. So there's that I feel like we're going to be in the middle of like some kind of a monetary revolution too. It sounds like Besant has a very strong idea. He's telling us the gold's there. He's telling us that the U.S. is in a very unique opportunity to grow our way out of this deficit somehow. Obviously, the first thing they're going to do there is cut out all of the waste, right? They're going to probably, I mean, who knows? They may go claw back millions of dollars from these politicians just for optics.
Wow.
Just to say, yeah, you actually can't become worth $100 million on $175,000 salary in 10 years. You just can't. So, I mean, I got a feeling that there are going to be revelations and machinations that are done that nobody in the country or in the markets was expecting or has discounted yet. So I'm literally still even though the markets are quiet and very sideways here, like my head is on a swivel for more market driving headlines. Cause I really believe the NASDAQ's trying to break away from 22K. The S&P has been trying to break above 6,200. We break above those levels in these two indices, and they're going to go on multi-year bull markets again. And then everybody's going to be like, oh man, we got caught up there. As soon as he got elected, there was some consolidation, there was some rotation, and the markets weren't going, and they were spinning their wheels for a little while. So what we did was we got out and we went and bought China, and then the US fucking took off again. Like that I could see happening.
Well, I'm here for all the fireworks that you just described, okay?
Me too, man. Me too. I'm literally, I don't leave my screens during the week, Gary. You know me. You know what I'm saying? Like, we're going to be here for this bull market for sure.
All right. So the U.S. faces a fiscal crisis with this soaring debt, the deficits, the interest expenses. It's basically leading to what's been called fiscal dominance. All right. There's an almost $10 trillion debt wall that Treasury Secretary Besant has to address this year in maturing debt. That has nothing to do with all the new debt. So it's real, and it's also a situation that's worsened by his predecessor and the reliance on the short-term debt issuance. So he faces this dilemma. Do I revert to the standard practice of risking the higher long-term rates and seeing the market tighten while continuing the previous policy, or keeping the same old policy going that the previous one did? And it's a mess. All right. So how do you expect them to handle the debt wall, and what ramifications from that method of handling it are you expecting?
So I could tell you, I don't know exactly how this is going to go, right? He sounds like he's got an idea that he may, or sort of that they said something about potentially rolling some out or swapping some out or something like that might mitigate the immediate pressure that it can put on the market. That I don't really understand well enough to explain, but I have a feeling that, we've already seen. Here's one dynamic about the story that's kind of the conversation in my head. By the time I find out, which was, and you find out, which is probably months ago, that we are running into a huge refinancing year, right? When you start talking about this for this year, like last quarter, right? By the time you and I find this out, I'm going to tell you that the market has already sorted it out.
Okay.
Right. And you might be able to say from the last 3-year bear market in bonds that a lot of treasury selling got done ahead of that, like got done ahead of this whole entire operation of refinancing. Right. So, and I don't know if this really covers it, but if we're worried about the debt load putting heavy weight on the bond market, right, the issuance putting weight on the bond market and rates going higher, well, we just experienced rates going higher, right? We just lived in 2 years of 5% in the 2-year.
True.
You know what I mean? Where rates were peaking, we saw foreigners heaving treasuries, right? Since Biden and Europe booted Russia out of the SWIFT system, that's when we've seen a lot of ownership changing hands, and that's when we saw central banks start buying gold, right? So it looked to me like every central bank with a massive risk-free, they thought, treasury position looked at that maneuver, I think that was in like February of 22 or something like that, and said like, oh man, that could be us. Like all we got to do is cross the wrong dudes and we're out of the SWIFT system and these treasuries
Right.
are useless. So let's sell some of these and get gold on the pad. And I feel like the market may have adjusted a little bit for that.
That's an
So
interesting perspective.
Yeah, if the market adjusted a little bit and got ahead of it and sold off all those bonds and saying, "Oh my God, here comes the tidal wave," maybe this is the low level. Maybe 5% in twos was like the bottom.
That's interesting.
Okay. I don't know enough about the bond market, but that's a little bit about how I feel here. And then if we managed our way out of sort of half of the risk and the Treasury Secretary can cover the other half, then it's going to be business as usual in the bond market.
Yeah. All right. Well, you've brought up gold a couple of times. Let's go over there. So, Tony, over the past 10 weeks, we've seen large amounts of physical gold flowing over to the U.S. into the COMEX. Something like 54 million ounces have moved in, something to that effect. This coincides with defaults on the London Gold LBMA. Also, contract holders, they're rushing to secure physical gold. They're exiting the London market. Swiss refineries are imposing surcharges. They're halting production. South Korea is getting into the act. They're halting shipments. If this situation continues to escalate like it feels like it is, what are the potential cascading effects downstream?
Gold, in gold, like I said, I don't think anybody knows what's going on, but it's trading like it's coming to some sort of a conclusion, right? It was trading up like we're waiting to find out. There's a little bit of some kind of a squeeze going on that people can't really articulate. We know that there's central bank buying. We know the market's pretty tight. The price is going up. It feels like it's going to crescendo for me, Gary. It feels like it's going to go up into once we all find out what this is all about, the gold price is going to peak and then fall back into trend is what I think. So I think you could stay bullish and I think it's the right thing. The one thing that I have to worry about though is that, there's so much regime change going on now and monetary regime change that I fear that the Trump administration could wind up being bearish for gold, right? If we go now and Besant starts making, headlines with any kind of, deficit spending slowdown, things like that. I mean, those are the things that the gold market was responding to on the way up. Every time Biden threw another trill dog on our national debt, gold went up another $100, right? Yeah. And people were like, what? 36 trillion? I got to buy more gold. What? 37 trillion? I got to buy more gold. Like, the purchasing power of the dollar is fizzling right in front of our face. And I feel like there's plenty of evidence that we are seeing the purchasing power of fiat currency go down the drain right before our eyes with the strength in gold and silver, with the strength in Bitcoin, with the amount of corporate funds that have flowed into Bitcoin. I mean, there are some really smart people with some really big stakes, in that cryptocurrency space. So I have to really respect that as people that are seeing the dollar losing or the fiat currency losing its purchasing power and saying that the system is begging for something else and making sure that they're in those securities. So I guess the short story is, Gary, that I feel very much in the dark about what's going on with the gold market and the gold price. I've remained long, but I'm very skeptical that this might not be, we might not come, peak gold into whatever headline we're going to find out is really going on, and then it could back off substantially. So that's just a kind of fear that I have. I'm going to have to trade the price action. If it breaks down below the 100 or 200 day moving average, God forbid, then I'm going to have to risk, I'm going to have to change my allocation a little bit. So.
Okay, so you've talked about the central banks loading up on gold. We've seen Asian citizens loading up on gold. We're now seeing Asian insurance companies having access to gold. But the Western investor, they're largely absent. They don't seem to really care much about gold. A lot of people are speculating it could have something to do with the preoccupation with tech stocks or Bitcoin or other things. So, what's your reaction to that? And do you think before the apex of this run that the Western investor is going to show back up at the table?
I don't know. I don't know if the social and cultural angle on gold is going to change much here in the US, especially since we've got Bitcoin now. And that seems like something that the next generation is certainly piled right into and cares about more than gold and things like that. So I don't know. I think that Bitcoin presents a really good competitor to that idea, to the idea that, more mom and pop in the West are going to start, socking physical gold away, like they do in Asia and things like that. So it's hard for me to see how that changes, even though it's different all around the world. Like it's like the same way, like, we've been eating different things than everybody around the world. And there's all kinds of crossover, this and that, but everybody still in their own country eats the same thing 1,000 years later. Yeah. So I kind of look at it as that's great. Maybe the West can continue to not really be that crazy about gold. Maybe not Joe Sixpack, but a lot of us that are, the investing public is certainly aware that gold is an option, and they've started, being friendly to that. I mean, hasn't gone from 1,800 to 2,800 because nobody's buying any. So I just don't know. I just don't know if I have an answer on how it becomes, that what could flip the switch and gold can become culturally more important here.
Yeah, I think your cultural angle is interesting. It's clearly extremely important to the global financial system. Otherwise, central banks around the world would not be loading up the way they have. So it's going to be interesting to watch. You brought up a couple of times that the miners are actually in a rotation here. They're actually leading. They're on the top of the leaderboard here since January 1. They've both, GDX and GDXJ are both up like 15-20% since then. Do you see a catch-up phase taking place here for the miners, or are you seeing this as more like a blip on the radar screen?
If you want to know the truth, I think the miners are sucking wind right now. I understand that they're up 21% year to date, but look at it this way. 2 months ago, the S&P was at 5,800. 5,800. Gold was 2,700. And gold miners were 44 bid. Now the S&P is at 6K, call it. Gold is 29.40 bid, and miners are 41 offered, or 41 offered. So explain that to me and tell me how their strength is. Gold did, the S&P went up 10%, gold went up 15%, and miners are down 5%. So to me, within this crescendo of the gold trade, where we're gonna like kind of rally this thing into uncertainty, and then there's going to be a sell the fact moment, and it's going to back off. What I think is going to happen is that gold stocks are going to get absolutely destroyed when gold does that. Like gold is going to pull back from like 2940 to 2700, and the GDX is going to go from 41 to 22. There's just going to be no bid on the way down. People are going to like, oh, it's time to be out of gold miners, and they're going to be looking at bids that they are not going to want to freaking take a look at, and they're going to be the only way out.
Yeah, as if they haven't been pounded enough over the last couple of years. All right, well, hey,
how many times have you seen that happen?
Yeah,
a dozen happened in your career. I mean, gold miners are traditionally bag holders, and the worst of their kind, because the view is, well, I've got physical metal, I never want to sell that. It's like, okay, well, you just took a 40% drawdown on your gold miners. How'd that feel?
Right. Okay, so hey, everyone. Welcome to this fantastic interview with Tony Greer, founder of The Morning Navigator. This has been an amazing discussion. Before we wrap up here, and I ask Tony our final set of questions, I just want to direct everyone interested in the metals and mining sector and investments to dive into our Substack at metalsandminers.substack.com. Join our community, receive a report for free titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. Consider upgrading for access to premium content. The premium content offers expert-driven insights on global trends, asset sentiment, and economic geopolitics, alongside some deep dives into the mining sector, providing comprehensive analysis for informed decision-making. Even without premium, there's plenty of free content daily. So visit metalsandminers.substack.com. Join us and explore. Thanks again for watching. Now, I'm positive that you've enjoyed the conversation with Tony as much as I have. please let him know. Hit the like and subscribe button and leave a comment below the video. All right, Tony, once peace agreements are finalized, a topic that President Trump has emphasized since before the election, the reconstruction efforts in Ukraine and Gaza will need to begin. Do you anticipate that this rebuilding process will significantly increase demand for construction materials, potentially kickstarting the next commodity cycle? And would this surge in demand likely exert some inflationary pressures on global markets?
So I thought the electronic vehicle mandate was going to cause a bull market in, a lot of base metals and things like that. And they were tight going in, and they were constructively trading going into that idea, and that whole trade fell apart. So in as much as that we're going to be rebuilding some couple of different countries, is that going to be enough to move the needle? Maybe. I sure hope it does. It doesn't feel to me like the conditions are set to go into any kind of a commodity super cycle by any stretch of the imagination. And I think it all starts with the fact that, start with the oil market. There's plenty of oil. There's plenty of refined products floating around in the harbor at the moment, right? Oil 70 bid, 72 bid, 68 offered, 72 bid, 60, oil likes these prices here. And I feel like it's a really efficient price for oil. And I think the gasoline price is going to go down even further because there's just going to be more and more refined products that we're going to be able to sell. And we're going to also open up a number of pipelines now. So I think the gas price is going to go down. That's going to be good. But it doesn't lead to, you kind of need to have the energy price driver if you're going to have a real commodity super cycle, right? Like you can have a little bit of a commodity rally. You can have a strong base metal rally in a weak dollar market, but that doesn't mean that there's no base metals around. It's just the denominator changing size, so that's like one of the things to think about. And it doesn't seem like there's a setup for, tightness in aluminum or copper or anything like that, where one of them is going to fly off the handle and there's going to be that shortage flywheel type of trade. So I don't think, while there may be some, measurable demand from those kind of rebuilding efforts, I don't know that it's going to be enough to really move the needle in the commodity markets in terms of creating a new bull market, if that's fair to say, Gary.
Yeah, that's fair to say. All right, so let's finish off the discussion with what I call a lightning round. I'm going to ask you to rank a few assets as a buy or a sell by giving it a score of 1 to 100, 100 being an extreme buy, 1 being an extreme sell. Just give one sentence as to why you take that position, okay?
Sure.
If you're not following it, it's fine. All right, on a scale of 1 to 100, is gold a buy or a sell right now, and why?
Gold is a man. I have gold literally as like a neutral hold right now, Gary, because I think that we're going to get a better chance to sell it, because I think there's going to be some kind of there's a squeeze in gold going on and we trade above 3K. So I think that that's a level that I would sell it at. But at the same time, I'm very concerned about all of this cost and budget cutting being really bullish treasuries. And if treasuries go on a massive run, some money's going to come out of the gold market. There's no doubt about that in my mind.
So what number? What number? Yeah, 50. All right.
Yeah.
Gold miner.
Sorry to middle you there, but I was neutral.
No. I want to know I want to know 1 to 100, the gold miners, buy or sell, and why.
Oh man, I'm like a 10. I'm like a 10. Like I'm like seller of the gold miners. Like I said, like there's going to be a crescendo in gold, and I think that they're all going to get quartered.
Silver, 1 to 100.
Seller of silver, 10 also. I think same thing can happen in silver as can happen in the miners, where silver is going along in sympathy with gold. Silver is much more of a industrial metal than a precious metal nowadays. And I think that people are long out the wazoo silver, expecting it to just fly away like gold is going. So I just think that that's the wrong way to look at that trade. And I think there's going to be a lot of bag holders there. So I think silver's a sale. So 10.
All right. Copper.
50. I'm neutral copper, man. It's literally in the middle of the range. There's no supply demand story. We should have enough demand for it to stay steady. I'm dead neutral copper.
Uranium.
Bullish uranium. I still think that tight, I call it a 80. I still think it's a market that you have to be in. I think that Chris Wright, Trump's secretary, is going to make that a more visible portion of the U.S. energy portfolio. And I think that at some point he just might announce that we're going to start opening up nuclear reactors here and there to start creating baseload power for whatever reason, for whether it's for computer generation, AI generation, or something or other. But I think that once that mechanism gets in place, that the price of uranium can go up. So I'm like 75, 80 uranium.
Uranium miners.
I worry about them like I worry about gold miners, right? Where the trade might be in the metal, but the miners have been performing, and like Cameco, like the lead horse in the race, is in great shape and still running strong. So I'm going to still say like 70, 75 in the miners.
Okay. NASDAQ.
100. I'm still bullish tech. You know, I'm a creature of performance, Gary. And when I see those three subsectors of tech break out like a house on fire and rally 25% when it's clear that Trump is getting elected and they haven't backed off much, those to me are going to be the next bull markets. Another thing that's bullish to tech to me is that DeepSeek was supposed to take the piss out of NVIDIA and, you know, cut it in half and puncture the business model. And what a crock of shit that turned out to be. NVIDIA is fine. It's going to be soaring towards the highs and probably keep going in no time. So I'm bullish technology for this administration, Gary.
The S&P.
90. You know, I mean, what I like about the S&P, Gary, is that you can't be bearish the S&P when cyclicals and resources are rallying with tech, you know, because there's no counterweight to your downside, right? If NVIDIA and Google and Mag 7 are going to take off, and you've also got a bull market in base metals and transports and aerospace and financials, it's like, okay, so where's the downside in the S&P? You know, so when I see cyclicals and transports and resources rallying with tech, like for example, gold miners up 20%, social media up 17%, gold and silver are up 12% on the year. The commodities index is now up 8% on the year. I mean, the commodities index is outperforming, you know, the XLE, it's outperforming energy stocks, it's outperforming biotech. You know, so there's some strength in natural resources around. And when there's strength in natural resources and cyclicals, and the commodity, the tech bull market is still in place, which no matter what you think of it, it's still in place right now. Man, I don't know how you can be bearish these indexes right now.
All right. Oil.
50 down the middle. Like I said before, we don't need to go over it. Oil likes these prices here. It might be either side of $70, but I don't think it's going very far.
All right. And lastly, on a scale of 1 to 10, with each representing a percentage, like 1%, 2%, where do you see inflation ending the year?
Ending this year, man. So I think it ends this year. We'll put it this way. Like I said, I'm not an economist. So where are we at? 3%?
Yeah, about 3. Yeah, a little over 3.
I think it ends this year probably a little bit lower via higher. Right? I think that it ticks up. I think we may see some 4% year over year sometime in the spring, like when the worst of the keeping rates low for too long kind of bites into the market. So I think that we see a bit of a peak of a spike in inflation, and not a spike. We see a mound in inflation, and then I think it narrows back off this year. That's kind of what I'm looking for, a little bit of a bell curve. So
maybe high 2s, like 2.8 or something.
Yeah. I want to see it go. I want to see it go up first. That's what I really think happens. So I'll just include that in the view. I do think that we print 4 handle in year-on-year CPI. Okay. And then, you know, the markets adjust to that, et cetera, and it's really not that inflationary. And then all of a sudden it sags back down into the high 2s or 3 or something like that. So I think that will pop up and then come back off.
Tony, thank you for coming on to Metals and Miners, for being so generous. It's always so much fun to talk with you. Would you please let everybody know where they can learn about your work, how they can connect with you, contact you, all that good stuff?
Yeah, man, I'll start with our free offering, tgmacro.substack.com. That's where the Macro Dirt podcast is that I do with Jared Dillian. Go there and sign up for it. We've got great growth, great response. You can follow me on Twitter at tgmacro, excuse me. And if any of your listeners want to email me, you can email me at tony@tgmacro.com.
Awesome. I'm going to put all that information up on the screen. Guys, you got to follow Tony. He's the best. He's the best. He's so much fun. And he tells it like it is. He tells it. He wears his heart on his sleeve, and he just lets it rip. So
thank you for noticing, Gary.
Yeah, it's true. It's totally true. So anyway, I love talking with you, and I'm going to have you back on sometime soon. Thank you for being here with us, and everybody else, thanks for watching.
Rock on, Metals and Mining. You guys are the best.
Thanks. Everyone, welcome to this fantastic interview with Tony Greer, founder of the Morning Navigator. This has been an amazing discussion. Before we wrap up here, and I ask Tony our final set of questions, I just want to direct everyone interested in the metals and mining sector and investments to dive into our Substack at metalsandminers.substack.com. Join our community, receive a report for free titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. Consider upgrading for access to premium content. The premium content offers expert-driven insights on global trends, asset sentiment, and economic geopolitics, alongside some deep dives into the mining sector, providing comprehensive analysis for informed decision-making. Even without premium, there's plenty of free content daily. So visit metalsandminers.substack.com. Join us and explore. Thanks again for watching.